Good evening. Welcome back to the newsroom. This is the 8-hour workday with Rex Haymarket, where every crisis somehow becomes your bill and their bonus. Tonight's story begins with a rocket ship, a chatbot, a retirement account, and one of the oldest tricks in finance. Sell the dream, move the risk, call it the future. Because some of the biggest private companies in the world are lining up to go public. And if this plays out the way Wall Street hopes, ordinary retirement money may end up buying these companies automatically. Not because you chose them, not because you studied the filing, not because you woke up one morning and thought, you know what my 401k needs? A $1 trillion rocket company with an artificial intelligence cash furnace attached. No, because index funds buy the index. And when the index changes, your money follows. That is the story. This is not just an IPO boom. This is a liquidity event wearing a spacesuit. Let's start with SpaceX. SpaceX is not just another tech company going public. This is being discussed as one of the largest IPOs in history, a company that may enter the public market with a valuation so enormous that on day one, it could be treated like one of the most important companies on Earth. Now, there are real reasons people are excited. SpaceX built reusable rockets. Starlink has become a serious satellite internet business. The company has government contracts, military relevance, global infrastructure, and one of the most powerful founder myths in modern capitalism. It has the perfect story: Mars, satellites, national security, the future of humanity. Very inspiring, very cinematic, very expensive. But the part that matters is this: SpaceX is not just one simple business. It is several businesses bundled together. One side looks like infrastructure, one side looks like cash generation, and one side looks like a bonfire built out of investor money. That is why the valuation matters, because when a company goes public, the public does not just buy the dream, the public buys the whole bundle. The profitable parts, the speculative parts, the debt, the burn rate, the hype, the founder myth, the rocket launches, the data center bills, all of it. Now here is where the story gets much more interesting. Most people think the stock market works like this. A company goes public. Investors look at the price. They decide whether they want to buy. Nice little fantasy, very democratic, very adorable. Nice little fantasy, very democratic, very adorable. But in the modern market, a huge amount of money is passive. That means it does not really choose individual stocks. It tracks indexes, the Nasdaq 100, the S&P 500, total market funds, target date retirement funds. All the things ordinary workers are told to buy because they are safe, boring, diversified, and responsible. And to be clear, index investing can be a good thing. Low fees, broad exposure, simple structure. But there is a catch. When an index adds a company, funds that track that index have to buy it. They do not sit around asking, is this a good price? They do not say, seems a bit bubbly. They just follow the rulebook. That rulebook is the plumbing of the financial system. And the plumbing is where the power lives, because if you can influence what gets into the index, you can direct billions of dollars in automatic buying. Not from hedge fund geniuses, not from venture capitalists, from regular people's retirement accounts. This is why the index rule changes matter. Some major index providers have been updating the rules. The key idea is simple: let massive new listings become eligible faster and adjust how low float companies are treated. Float means the portion of shares actually available for the public to buy. So imagine a company has 100 total shares, but only 5 are available to trade publicly. That is a 5% float. Under older rules, that kind of low float could make it harder for a company to qualify. But if rules change, a company can list with a small slice and still trigger large automatic demand from index funds. That matters because a low float plus huge demand can create a very convenient situation for insiders. Small supply, massive forced buying, very high valuation. Wonderful if you got in early. Less wonderful if your retirement fund shows up at the end of the line holding a paper plate and a tiny fork. And that is the central question. Are these rule changes modernizing the market? Or are they helping private investors hand giant valuations to the public before the music stops? In finance, there is a phrase people do not like to say out loud: exit liquidity. It means the buyer who lets the early investor get out. When a company is private, the early investors may be sitting on giant paper gains, but paper gains are not the same as cash. To turn those gains into real money, somebody has to buy. And when the valuation is massive, you need very big buyers. Who is big enough? The passive investment machine, the retirement system, the index funds, the ocean of 401k money that buys automatically. This is the part that should make people sit up, because the sales pitch will be about access. Retail investors finally get access. The public finally gets access. Ordinary people finally get a chance to own the future. But access at what price? That is always the question, because getting access after insiders have already marked the company up is not the same thing as getting in early.
That is not access. That is arriving at the party after the champagne is gone, the founders have left, and someone hands you the cleaning bill.
Now, to be fair, SpaceX is not fake. That would be lazy. The rockets are real, Starlink is real, the technology is real. The question is not whether the technology matters. The question is whether the price makes sense. This distinction is everything. A technology can change the world and still destroy the first wave of investors. Railroads changed America. Many railroad investors were wiped out. Fiber optic cables built the backbone of the internet. Many fiber companies collapsed. The dot-com boom gave us the internet. Many investors got buried. Technology winning does not always mean investors winning. Those are two different stories. And right now, AI and space infrastructure are being sold as one giant future package. But the package includes very different businesses. Starlink looks like a serious global infrastructure company. Rockets have real government and commercial demand, but artificial intelligence requires staggering amounts of money. Data centers, chips, power, cooling, cloud contracts, debt. And the strange part is how much of the AI boom depends on giant companies spending money with each other. Here is the AI loop. Big tech invests in an AI startup. The AI startup uses money to rent cloud computing, often from the same giant tech ecosystem. The cloud provider books revenue, the startup shows growth, the valuation rises, the investor marks up the value of its stake. Everyone appears richer, everyone appears smarter, everyone goes on television and says the word transformational 12 times. But the actual bills are very real. The chips are real, the power usage is real, the data centers are real, the corporate debt is real, and the electricity bill does not accept payment in vibes. This is why some analysts are worried that the AI boom is not just a valuation bubble, it may be an earnings bubble. That means the stock prices may not look completely insane compared to reported earnings, but the earnings themselves may be inflated. That is much harder to see. In a normal bubble, the price goes crazy. In an earnings bubble, the earnings look healthier than they really are, right up until they do not. Now let's talk about retirement. So when you buy the broad market, you may think you are buying America, but increasingly you are buying a giant AI trade with some banks, grocery stores, and insurance companies sprinkled on top for decoration. That does not mean you should panic. It means you should understand what you own. Because if AI keeps working, great. If AI disappoints, the pain will not stay contained in a few speculative tech stocks. It can hit retirement accounts. It can hit target date funds. It can hit people who never bought a single individual AI stock in their lives. Because if AI keeps working, great. If AI disappoints, the pain will not stay contained in a few speculative tech stocks. That is the strange brilliance of the modern financial system. You do not have to believe in the bubble to be exposed to it, so why now? Why bring these companies public now? Why change the rules now? Why open the gates now? Maybe it is innocent. Maybe the market is simply evolving. Maybe these companies are too big to ignore. Maybe. But there is another possibility. The window may be closing. AI spending requires cheap money. It requires investors to believe the story. It requires bond markets to stay calm. It requires energy prices to behave. It requires workers to keep contributing. But the world is not exactly calm. Energy shocks can push inflation higher. Higher inflation can keep interest rates higher. Higher rates make debt more expensive. More expensive debt makes giant AI infrastructure build-outs harder to finance. And if the cost of capital rises, the math behind the AI boom gets uglier very quickly. That matters because the AI story is not cheap. It is one of the most capital-intensive industrial build-outs in history. Data centers do not grow on trees. Neither do GPUs. Neither do power plants. So if you are an insider sitting on an enormous private valuation, the best time to go public is while the story is still beautiful, before the market asks too many questions, before rates bite, before earnings wobble, before the paper gains meet the real bills. Now, not every index is moving the same way. That is important. Some indexes allow faster entry, but the S&P 500 is harder. It has stricter requirements, more friction, more weighting, more proof. That matters because enormous amounts of retirement money track the S&P 500. So while the hype machine screams, "The future is here," the S&P is basically saying, "Lovely spaceship, show us the paperwork." That does not mean they never get included. It means the market has more time to judge more. And time is dangerous for a hype cycle. Because private valuations are negotiated, public prices are tested. Private markets can say, "This company is worth $1 trillion. Public markets can say, "Cute, prove it." The world-changing technology survives. The first financing structure often does not. And then, after the crash, someone else buys the same assets cheaper and builds the next era. That may be the future of AI. The technology may win, the early public market buyers may not. And that is what makes this moment so dangerous, because ordinary investors are not being offered the garage stage version of the future. They are being offered the $1 trillion version, the version after the insiders have already made their money on paper. The world-changing technology survives. The first financing structure often does not. And then, after the crash, someone else buys the same assets cheaper and builds the next era. That may be the future of AI. The technology may win, the early public market buyers may not. And that is what makes this moment so dangerous, because ordinary investors are not being offered the garage stage version of the future. They are being offered the $1 trillion version, the version after the insiders have already made their money on paper, the version where the public shows up to validate the valuation. So what should ordinary people do? First, do not panic. Panic is how Wall Street gets your assets at a discount. Second, know what you own. If you own broad index funds, look at the concentration. How much is in big tech? How much is in AI adjacent companies? How much could be affected by new mega IPOs? Third, understand the difference between a good company and a good price. SpaceX can be impressive and still overpriced. AI can be transformative and still overbuilt. OpenAI can change the world and still disappoint. Anthropic can be brilliant and still arrive at a terrible entry point. Fourth, be suspicious when the public is told it is finally getting access. Access after a markup is distribution. And fifth, remember this. The most important stories in finance often hide inside boring words. Float, index methodology, capital expenditure, free cash flow, waiting rules, bond yields. That is where the bodies are buried, not in the press release, not in the launch video.
Not in the founder's TED Talk, in the footnotes, in the plumbing, in the machinery that decides where your money goes while you are at work.
So no, this is not a simple story about SpaceX. It is not even a simple story about AI. It is a story about how the financial system absorbs a speculative boom. First, the insiders fund it, then the private valuations rise, then the story gets polished, then the index rules adjust, then the public gets access, then retirement money arrives, and finally, if the price was wrong, the losses become diversified, which is a beautiful word in finance. Diversified means everyone gets a little piece of the problem. The technology may be real, the future may be real, the rockets may fly, the satellites may connect the planet, the chatbots may write your resignation letter before your boss even fires you. But none of that answers the only question that matters to investors. At what price? Because there is a difference between funding the future and being used as exit liquidity for the past. And right now, Wall Street is not asking whether AI will change the world. It is asking whether your 401k will buy the shares. Clock in, mind the static, mind the spin, and mind who profits. Like and subscribe and click the next video on the screen to clock in for the next shift. I'll see you there.